Financial portfolios are like belly buttons. Everyone's got one, and some are stinky. But what does a financial portfolio look like when you're just starting to build wealth? Do you want to build each part simultaneously or build a section at a time? How do you know if you're doing it right? How do you get caught up if you're behind? There's so many questions, but we're here to ask, what if it were easy? Seriously, what if it were easy? Hi, I'm Amanda, and welcome to Wealth Wisdom Financial Podcast, episode number 103, Financial Portfolio Construction for Building Wealth.
And I'm Brandon, and we get asked all the time about portfolio building. There are so many different ways of thinking and mixtures of different financial products and different ratios that it can get challenging, right? It can sometimes feel like it's all just a personal decision, and it is in a lot of regards. You build what's right for you, and I'll build what's right for me. That's kind of how it ends up. Yet we believe there are a few fundamentals that apply to everyone and across generations. We're going to share those today, and they aren't very conventional, of course, because, we are not your just typical conventional people.
Yeah. In fact, are you sick and tired of hearing the same old conventional financial advice? If so, we feel you. We're fed up with those same old truisms that fall flat when you get into the unique opportunities and challenges of specific situations. This show is all about bringing you historic wisdom around building wealth with practical insights on how to apply it to your journey today. When conventional financial thinking doesn't get you where you want to go, you need wealth wisdom. Let's master wealth building together.
Let's start with a fun analogy. We learn as kids with blocks that you can't build a castle all willy-nilly like. Actually, I was doing that stuff this morning, actually. We were recently teaching our preschooler that he needs to put the bigger blocks on the bottom to hold up the smaller blocks. If he starts with the smaller blocks or just builds with whatever blocks are most convenient to grab, the entire construction project eventually ends up right where he started, a pile of blocks on the floor and a huge mess that he's going to clean up, and lots of Legos that may hurt our feet.
Again, we all learn this as kids with our Legos, even like the preschool type Legos, the big ones, right? You have to be intentional with how you build. Haphazard Lego building doesn't end very well.
It goes to a crash, right? Yet when it comes to building our financial futures, we pick up this block here and that block there. We see so many people picking whatever is easiest to use or whatever a close friend says they should do. No wonder too many end up with haphazard financial castles that tumble over the minute there are economic tremors or challenges.
Sure, you can make good decisions in the moment when opportunities present themselves, but do you want a good financial life or a great one? Do you want a toddler's Lego build or a Lego master build like you'd see at Lego's headquarters?
I'd rather the Lego headquarters build. Just like there's a superior way to build with Legos, there are better ways to construct a financial portfolio, especially if you're trying to build real wealth.
Now, I can hear you starting to think, yes, I know I'm in your earbuds, but I can literally hear your brain. No, just kidding. I'm imagining a lot of you are starting to think, okay, yes, I want to be intentional. I believe being intentional will help me build wealth. But how do I know which parts of a potential portfolio are like big Legos and which are the smaller ones? How am I going to know if I'm doing it right? That's why I hand it off to somebody else to do it for me. There's too much to learn. It's super overwhelming. I'm just going to go at it all haphazard. What financial portfolios are you talking about that are best for building wealth? And how could this ever be easy?
And we hear you for sure. I mean, actually, there are over 450 different financial products and as many ways to combine them as there are people in the world. So, I mean, it's confusing and a lot.
That's why we said financial portfolios are like belly buttons, right? And unlike belly buttons, with financial portfolios, there's actually no shortage of opinions about what yours should look like.
Everyone has one, right? For sure.
One person says crypto is where it's at. Another person says you better own some precious metals. The HR person hammers into you that you better take the company match with the 401k and then just let the target date fund handle the rest, and so on and so forth.
We hear these opinions all the time. I mean, just this morning. And we add a little bit of this and a little bit of that to our financial lives. And then voila, there it goes, right? The problem is that when we end up with a haphazard financial life where this product over here is gathering dust and that product over there is causing us anxiety, when we could combine the two or use them in coordination and see our goals become reality. But because we have something over here, something over there, it just gets a little confusing.
Yeah. And this reminds me of something called silo thinking. It's kind of a corporate term where you don't pay attention to the whole. You only are paying attention to the parts, but you might lose parts and you might even have parts competing with each other. And as I was thinking about this, I came across this example that I think is a great example of kind of a wealth wisdom that actually comes from outside of the typical wealth world. It's not an economist. It's actually in the 1950s, a French sociologist, Pierre Bourdieu. I don't speak French. My apologies if I'm pronouncing that incorrectly. Pierre, a French sociologist.
You got Pierre right.
I got Pierre right, hopefully. He grew up in a poor rural village. He left, he fought in a war. He came back to that poor rural village to kind of study its folkways, as a sociologist would. And part of that study, he went to the village dance. But as a sociologist, he looked where no one else was looking. The center of attention was the dancing. But on the outskirts of the crowd were a group of men considered unmarriageable because they were farmers. And in the 1950s in France, most women wanted to marry men with professions. It was a insight from how the Industrial Revolution had changed his community and their folk ways, right? Pierre used this insight from looking at the whole of his community rather than just what everyone else was looking at to catapult his activism for those who he believed to be subordinated by society and how it had changed due to the Industrial Revolution. He spent his career questioning those in power and how they tried to focus everyone's attention. And then Pierre brought wisdom to how social classes preserve their social privileges across generations, despite saying that they're trying to create a more equal world. We'll put some links to some more information about Pierre, but you can look him up on Wikipedia, read a bunch of stuff about what he did. But I wanted to share this story as an example of silo mentality. It's usually talked about in corporate America where departments in the same company compete rather than cooperate. And it's been shown to have some pretty disastrous effects. Particularly, silo thinking is pointed to as one of the causes of the fall of Lehman Brothers in 2008. This kind of fractured thinking that comes with silo mentality affects not just your microeconomy, but our financial institutions, our public policy, and so on and so forth. But let's focus in on you. How do we stop thinking in silos about our financial portfolios? How might we gain fresh insight by looking at the outskirts of what it might seem that the crowd is doing? What might it look like to shape our own holistic financial portfolios where the different parts help each other and boost each other rather than compete with one another?
From our research and experience, we believe there are 3 time-tested pieces of wealth wisdom that can help you create a financial portfolio that builds wealth. They are 3 powerful questions because remember, wisdom is about finding the right questions. And if you don't remember that, go to, I think, our last episode or the episode before that on that, rather than just the right answers. We want to ask the right questions. The answers can change as life changes, but the questions are timeless.
Here we go. Here are 3 powerful questions for constructing a financial portfolio that's really going to help you build wealth. Question number 1, what's important to you about building wealth?
Yeah, each individual or couple do this with your significant other if you have one. And they all have their own reasons to building wealth. Even Amanda and I have different reasons, right? Then there are different ways to build that wealth depending on its purpose. So you might have different, again, skill sets, all kinds of things that would tell you which way to build wealth.
For example, building wealth to make sure a single individual can have financial freedom as soon as possible is going to look differently than building wealth to set up multiple generations within a family to never have to worry about money again.
And remember, wealth doesn't even have to be about money. It could be about being able to go on a field trip with your kid whenever it comes up, right? It could be anything. What's important to you about building wealth might be the time freedom or sleeping well at night. Like those are not necessarily money, but it could be something that it produces.
What we found helpful is to just free write or type, if you prefer to type, and start with the phrase, I want to be wealthy because, and then just write or type whatever comes to mind. There are no wrong answers.
And after you've emptied all your thoughts and feelings related to the importance of building wealth and defining what wealth is, you can go back through and highlight or circle 3 to 5 phrases or words that seem to be most important to you. And then after that, you're ready to go on to question number 2.
So question number 1, what's important to you about building wealth? And then question number 2, if you were queen or king of money, what would you want your money to do for you?
And you want to start without financial products in mind, right? You want to take off the labels and start without the financial products in mind and list qualities, then prioritize those qualities.
For example, everyone would probably say they want their money to grow. I haven't met a single person that's not interested in growth in some way, shape, or form. And if it's not growing, right, it's because you go backwards because there's actually inflation. So, if growing might mean keeping up with inflation. But a 55-year-old might put safety much higher than growth, knowing that the 5 years before and after retirement are when they're most vulnerable to volatility.
Be careful when you put access too. Most people put that lower and then they run into issues, right? They think that I don't need that until later. Life is going to throw you curveballs. If you're in business for yourself, those curveballs can happen more often and have bigger curves, right? Most people lock up almost all of their wealth in their retirement accounts like 401ks and IRAs. Yet when a curveball comes, those accounts are off limits, unless you're okay with the 10% penalty, of course. And the rule of getting around that 10% penalty are super strict. And you definitely can't use it for a new roof or a new car, even if you technically qualify for a hardship withdrawal under IRS rules. An employer 401k doesn't have to let you take it. And that's serious. I mean, like for real.
So as you're listing out your qualities of what you want your money to do for you, and then you're prioritizing them, you're ranking them by what's most important, be sure you consider access carefully. It's not just about emergencies, it's about flexibility and opportunity as well.
Now that you have more clarity on what's important about building wealth and what you want your monetary wealth to do for you, you're now ready for the next question, question number 3.
So question number 1, what's important to you about building wealth? Question number 2, if I were queen or king of money for the day, what would I want my money to do for me? And then question number 3, how do I want to build?
So far, you're acting like an architect of your financial future, right? You're designing your wealth according to your dreams and what you want. The next step is to switch from architect to engineer. Sure, the architect can dream up the fanciest, more outlandish buildings, but then the engineer has to figure out how to make it happen. What will make it structurally sound while also fulfilling the dreams of the architect?
Now, this is a super important part of this. Too many people skip too quickly to actually grabbing building materials and financial products, like a 3-year-old grabs Legos. don't rush this part of the process of deciding how you want to build.
Yeah. And those pieces also may have different parts in it. Like you might have some aspects of what your money does for different things, I would think. So ready for a hot take on how to build your dream financial portfolio? Try this for size and see how it fits. Rather than build a diversified portfolio right away, focus on installing one element at a time and start with your foundation.
Now, that's pretty controversial to say. That's why we called it a hot take. Rather than start with a diversified portfolio right away, focus on installing one element at a time and start with a foundation. Let's break that down. Most people would imagine building a diversified portfolio by getting something like $1,000 cash fund, liquid emergency fund, right? And then going directly to index funds, mutual funds, or ETFs because you can have immediate diversification versus buying individual stocks. Good in theory, but what if you build up a fairly large cash reserve and then start to add riskier assets after you've covered your access needs? What might that look like, and how might that change your ability to build wealth?
And this is why we love the bank on yourself concept. Over the last 8+ years, we've built a fairly large cash reserve that we've already used to pay off debt, get through an emergency, take a bucket list trip that I really wanted to take, and buy a home. It's been instrumental for us to have that liquid accessibility cash so we could do those things. If we hadn't had started banking on ourselves, we might still have student loan debt. We wouldn't have been able to sell our business as well, and we would probably still be renting. And we 100% wouldn't have this podcast because we wouldn't be there.
We wouldn't be where we are today. Now that we're in this stage of our lives where we have this stability of no debt to banks, we have a home, we have our family, we're ready to really catapult our wealth building into some of those riskier investments. And guess what? We can use our bank on yourself type policies to do two things at once. While we pursue quote unquote investments, our cash will still grow within our policies because we have a properly designed policy with the right kind of company. And I don't want to rush this too much because I feel like maybe possibly people who never set up a foundation, they start with, trying to get super diversified right away. Mm-hmm. What ends up happening is that life happens, things come up, and they keep having to destroy their compound interest. They keep having to go into debt. Something always keeps happening that they can't get ahead. And that might not be true for everybody, but I see it happen for a lot of folks that I talk to that are, a couple decades beyond me in terms of time, but never set up that foundation. And that's part of why we talk so much about setting up a foundation, is because we see how important it is and how not having one over the course of time, life is going to happen. There's going to be resets in the market. There's going to be roofs that need to be repaired, cars that are going to need to be purchased, root canals that are going to happen, like all the things. If you don't have enough foundation, that can totally get in the way of building true wealth. Okay, I'll get off my little soapbox there.
And we know that can be controversial and all of that, but that's our take on it. And I believe, it has been a lifesaver. Not everyone is going to agree with that approach. And, there's all the haters and naysayers, but it does have its place. We just wish more people would consider it and the advantages that it can have. At the very least, we see too many folks nearing their older years with a haphazard financial portfolio because they didn't take the time to be an architect and engineer of their own financial house. And I don't want that to be you. I want you to take the time because I don't know, it's only your future.
So to sum up, we want to underscore this. Rather than a haphazard financial life, you can build your unique portfolio in a way that it has a rock solid foundation that you can count on no matter what's going on in the economy or on Wall Street. And that's a very powerful piece of wisdom that some people just never hear.
And we're told no risk, no reward, right? And you've also got to speculate to accumulate, which is like telling a preschooler that if he wants a tall Lego castle, then he needs to put the smaller blocks on first. And that isn't logical.
So if you're looking for strategies to stabilize your portfolio, we'd love to help you remodel and strengthen your foundation. That's our specialty, working alongside folks to master wealth building by making sure their foundations are solid.
And notice we didn't say put everything into the foundation. We're simply saying make sure you've given your foundation the attention it deserves. And if you're ready to replace the no risk, no reward with reliability is reward, then schedule your 15-minute intro call with us today.
We'll put a link in the show notes. I have to just say, that idea of reliability is reward in and of itself. You're not going to hear very many financial professionals tell you that. You're going to hear them say, you got to take risk. If you want to get to your goals, you're going to have to take risk. And we're here to say that is not true, that you can be set for life without taking unnecessary risk. So as you're learning new information, you're hearing these competing ideas, you're coming up with fresh ideas, you're going through those questions we shared earlier, it's going to be difficult to decide what to carry through with and when. We're here to support you, but we've also developed a filter to use when deciding how to move forward to your goals and dreams, financial and otherwise. It's a free gift for you waiting at stillmethod.com. Go download it today and start connecting with your intentional financial life.
Yeah, so that's stillmethod.com for that. And if you want to schedule a call with us, go to grandmaswealthwisdom.com/call, I believe, and you can schedule a call there. So next time, be sure to subscribe because we're going to be defeating a very common reason people give up on the process of being the architect and engineer of their financial house. So we're going to talk a lot about why people don't even go there. As you start to answer the 3 questions for today, if you feel like you need a bottle of antacids, then this next episode is going to be for you. So a little cliffhanger there. It's going to be fun.
Until next time, keep building your financial confidence. We hope you live long and profit. The topics presented in this podcast are for general information only and not for the purposes of providing legal, accounting, or investment advice. On such matters, please consult a professional who knows your specific situation.
This is thepodcastfactory.com.